Hi, good afternoon, everybody. Welcome to our webinar for this week. My name is Sean van den Berg. I head up client education at PSG Online. I hope you guys can hear me clearly. Someone you can just quickly respond, those of you that have, thank you very much. But just so you can hear me, great, thank you very much. Okay, guys, welcome to our webinar for this week. Like we do with every webinar, any questions you guys have, just type in the little box. In the questions box, and I can hear you. Answer your questions as we go along. Obviously, most of the questions I will be able to answer while we go through the presentation. If I don't answer your questions, I'll be following up with email. Again, with every single webinar that we do have, those of you that do attend, I'll be sending you the recording as well as the presentation for review purposes. And obviously, any questions you have from that, you're welcome to phone me again or email me. Okay. So let's get started. Let me just show you the agenda for today. We're going to discuss quickly a quick introduction to what is macro fundamentals, and just touch on the tools for managing the economy. I can't talk about investment cycle unless I talk about the monetary policy and fiscal policy. And obviously the main focus today is obviously on the investment cycle. And like we do with every webinar, I obviously promote other webinars coming up. So obviously this webinar will tie in with the webinar we're having in 2 weeks' time about inflation and interest rates and things like that. So it might be a bit of a crossover or overlap between the two of them. Just bear with us. Okay. So let's get started. The idea of these webinars, they're short and sweet. I'll make them half an hour, but we can do it every week. Okay. So quickly, what is introduction? What is fundamental analysis? It concerns itself primarily with the question of future profitability. You ask the question, how good will the company be as a generator of future dividends or future profits? So the basic assumption is profitability of the company will be determined the path of the share going forward. So obviously, if the company is in the growth phase and it's profitable, the share price should follow trend upwards. Obviously, a company is loss-making and for no growth prospects, you'll see that share price falling. Okay. So from a fundamental point of view, there's two types of factors we use to determine the intrinsic or true value of a share. We talk about the macro fundamentals, which is the factors that affect the whole market or the market as a whole. This is looking at the big picture. We're looking at the economic and political and monetary factors. And that's what we're going to be focusing on in the next few weeks as such. And then obviously the other side of the scale, we talk about micro fundamentals. You're looking at the individual company or the group of companies, more specifically the company's financial statements. And we use various parameters or financial ratios to help us determine the growth prospects for the company, in so doing analyzing that company. Okay, so that's just quickly a introduction to it. We're going to focus, as I say, on macro fundamentals. The idea here is that we determine the state of the economic environment, okay, and obviously the implications of that environment for making investment decisions. So the main focus, as I said just now, is growth. Growth is your focal point when analyzing equity investments. Obviously, it's the growth in earnings as well as in cash flow. That will be shown in obviously in the share price and also in the dividend growth and the income, the growth in those dividends. So obviously dividend yields offer a substantially lower reward than bonds. So to make shares a desirable investment, you would expect that the share price will grow higher or to close that gap between the current bond yields and the dividend yield. Okay, so that's what would encourage you to get involved there, the growth prospects. So your goal as an investment, as an investor or as a fundamental analyst is to form some form of judgment on the company's future, the secular long-term growth. When I say secular, that's a long-term growth of the economy and obviously all the components that make up the economy. But also, your opinion should be concerning the cyclical outlook for the economy. You know, the market moves up and down in cycles, and so does the economy. Okay. We'll be discussing that in this presentation today. So let's talk about economic analysis. When we talk about economic analysis, you can talk about business cycles, all very much the same thing. So here's just quick some background, economic and demographic analysis. This will form the background for industry and company analysis. By the way, this presentation is taken from the online tutorial on our website, Macro Fundamentals, tutorial number 3. So this is where I base it on, so you can go read up more on it. The economic analysis obviously provides that background for estimating, number one, the level of interest rates, and obviously what's also important is the long-term trend for price earnings multiples, price earnings ratios, and that's obviously where valuation comes in when you look at the stock market and specific shares. So your goal as such is to determine what sectors in the economy offer better than average profit opportunities. And obviously you want to relate that information to specific companies. So when I talk about demographic data, here's an example from 1950s, where there was a change in the growth and age composition of the US or the American population. They found that a large percentage of the population was presented by the youth, as well as that by the old. Okay, and they were increasing. That percentage of the population was increasing significantly. However, the middle age group was static or declining. So there was this change in the demographics, in the sense that, just using examples of the Levi Strauss, the jeans. So these guys were selling jeans and manufacturing clothing that were favored by the youth. So you would rush out and bought some Levi Strauss shares to take advantage of that growth. On the other side of the scale, we would have sold the shares of botany. These guys were manufacturing suits for the middle-aged businessman. So obviously, if you had followed those recommendations, selling botany and buying Levi Strauss, those recommendations would have been quite profitable. But also just changes now in the States regarding healthcare and things like that. Things like that will, and there's a lot of changes all the time. You want to be anticipating those changes and taking advantage of them. So it's that understanding of that interaction between the various variables in the stock market will help you make better projections in the market. Okay. Let me see any questions coming through. Guys, when you write questions, just keep them short, because my little box here I'm reading in here is very, very small, and long questions takes me a long time to read it. So just make it smaller. Here's a question here from Jack. What is the connection between the exchange rate changes and the JSE? Do various sectors react differently? Could you kindly forward the link to record a version of this webinar? Okay, yes, obviously everybody's on this webinar will be getting the recording as well as the link. Jack, to answer your question, I'll be coming back to just now anyway. Obviously there is a big influence of the exchange rate on the shares, especially what they call rand hedge stocks. Any company that benefits from a weaker rand, because obviously you're converting those dollars into rands. You're getting more rands for your dollars. Companies like that will benefit from a weaker rand. So your exporters, your companies that are based overseas, that have operations overseas, repatriate those funds back will be more profitable. On the other side of the scale, obviously a weaker rand is not good for the importers. Companies that import machinery, companies that bring in things, for example, machinery and that kind of stuff, will not be doing so well. Okay, but thanks for your questions, Jack. I hope it answered your question. Okay, let's move on. Let's talk about the tools for managing the economy. Okay, now, as I say, I'll be touching on this again in 2 weeks' time when we're talking about inflation and interest rates and GDP. But here's just a quick introduction. There's a need, when the need arises, the government would intervene in the natural course of the economic events. So obviously government is a big player in the economy. They would intervene to try and achieve certain desired goals. Obviously economic growth, very, very important, but also obviously employment. So, it's a bit of a balancing act where economic boom is getting out of the hand. This is where prices are surging to unacceptably high levels. This will put a strain on the balance of payments, and obviously the government will step in to cool down the economy. And that we saw a week or so ago with John Marcus, the Reserve Bank governor, raising interest rates. That's what the government uses, especially like through the Reserve Bank, to intervene in the economy. So the idea is that you'd manage your economy when there are constraints imposed on the economy. For example, as I mentioned now, the balance of payments, or you want to improve the performance of the economy. But the focus, obviously, with the Reserve Bank is inflation, and we saw last week that obviously because of the weakness of the rand, that's having impact on imported inflation, especially with the oil price and food. That's putting pressure on inflation. So the Reserve Bank uses monetary and fiscal policy, we'll be talking about these now separately, to stimulate or suppress economic growth. So monetary and fiscal policy should react in unison. They should be moving up together. And your goal is to anticipate this change in trend in both policies, and obviously anticipate that change in the trend in the share market, if you have tied back to the market. So let's talk about monetary policy. It's administered by the South African Reserve Bank. So this mainly concerns the level of money in the economy, and obviously we're affected by the level of interest rates. And coming back to your question just now, obviously, Jack, with the exchange rate. So always remember, interest rates is the cost or the price of money. So, for example, in the money market, if it's a short supply, you'll find that interest rates will be high. If it's freely available, interest rates will be low. Now, we've been at 30-year lows now on our repo rate and our prime interest rate, and now we've seen the first increase in our interest rate in 6 years. So obviously the bank, through Reserve Bank, through its banks, through the banks, would directly or indirectly increase or decrease the money supply. So you start getting your statements from the bank regarding your credit card loans and your car loans and your bond. You start seeing that you're paying more on those loans. Interest will be affecting that, and obviously we're taking out cash in the economy. Okay. So a higher level of lending by the banks will increase the supply of money, and obviously the effect of that is, or the theory behind that, you expect a higher level of transactions to be taking place in the economy. So obviously leading to higher economic activity. But that also results in higher level of imports and lower level of exports, and obviously the reserve starts running down. So when you start seeing these things happening, you want to take cognizance of it, be aware of it. And all these figures are published regularly. The money supply figures, all that kind of stuff, is published regularly in the press and on the Reserve Bank website. So interest rates are very, very important pointers to watch for future monetary policy. Now this little 0.5% increase we had last week might be a precursor for more to come. So when interest rates are high, obviously the authority, the Reserve Bank, will take some fiscal action to slow down the economy. So it's not slowing down the economy, it's just demand for goods, because obviously that's a pressure for inflation. When interest rates are relatively low, authorities will take action to re-stimulate the economy. And you'll see a graph just now how these all fit together. So there's a little picture of our Reserve Bank Governor, Joel Marcus. As I say, she increased the repo rate, which is the rate between the Reserve Bank and the commercial banks. They increased it by 50 basis points to 5.5% last week. As I mentioned, it's the first increase in 6 years, and the main aim was to head off inflation pressures due to the weaker rand. Okay, so yeah, you'll see more of it in the news this year, and obviously you need to be aware of those things. When we talk about fiscal policy, this is looking at the government's tax policy. So it's the government making conscious use of its own spending power. So they impose taxes, obviously, to also influence economic growth. And the budget is the main document that the finance minister would use to discuss its fiscal policy. So, we talk about allocating resources, its funds to various projects, might be road building or education. But obviously, the focus there is to help provide work, for example, to contractors and other suppliers in that industry. And the goal is to stimulate economic activity. And obviously those wage earners will go and spend more money in the economy too. So it's this whole, what they call the multiplier effect. As I mentioned just now, monetary and fiscal policies should be coordinated. They should move together. However, these things don't always work that way. You'll find that sometimes the Reserve Bank increases interest rates to dampen economic activity. But then on the other hand, the government continues to spend, and that's what we're seeing at the moment. Okay, so it's a bit of a quandary for them, where these guys are the government's under pressure to increase spending, especially on social upliftment, and obviously the focus is a lot on schooling right now. But also their focus should be on strict monetary policy. And I know some of you are all thinking, yeah, sure. It's not happening at the moment. And there's a lot of things we can go down that road. It's not working. Okay. So the budget is just the accounting exercise that we're matching up anticipated income with planned expenditure. So it's a very important document. It helps, especially businesses, to help to plan ahead. You need to ask yourself, when you read the budget speech in the newspaper, is the government adopting an expansionary approach to the economy or not? Are we increasing or decreasing expenditure? Will there be a higher or lower taxation rates? What sector of the economy will benefit from the budget speech? Where is the spending priorities? Those are the kind of things you want to look for within that budget speech. You'll see on the next slide, we'll talk about Provident Gordon. As I mentioned, it's a tool. The budget speech is a tool that helps us determine where is the government going to focus on. Okay. So I'm not going to go into too much detail. We're running out of time. But when you get this presentation, just go into more detail. There's a picture of the Finance Minister, Provident Gordon. That was his midterm speech in October last year. End of this month, Wednesday the 26th, at 2 o'clock, that's where we'll be doing his budget speech. And as I say, very important to either listen to it. I prefer to get hold of the newspaper. They usually have a supplement to the budget speech, and obviously a lot of analysis on that. Very, very important to get that and anticipate where the opportunities lie this year. Okay. But this is what I'll focus on quickly before we end up the investment cycle. Okay. Like most things in life, we all know the stock market works in cycles. Okay. So share prices do not always go up. Usually they always go down. Okay. But the general trend, the long-term trend is up. So that's in your favor as an investor. So as the economy is growing, and obviously businesses are feeling that growth, those companies will be worth more. Okay, those are the companies you will be focused on. Okay, so your focus should still be on creating a well-diversified share portfolio, and that will always outperform inflation, and also always produce positive results. You don't have to be a whiz-kid in the selection process. So over a period of time, you know, a long-term trend. If you're buying into good quality, undervalued stocks, you should be doing okay. Obviously, in the short term, you know, it's not so lucky when your portfolio drops off 50%. So that's why it's important for you to understand the things that will help you, or the variables that help you determine the investment cycle. It's being aware of the changes in direction, and we'll talk about it just now, and anticipate those changes. So normal economic cycle, basically we have this boom and the bust situation. That's the normal economic cycle. Basically, there's 4 phases in the cycle. And we'll discuss those phases at the moment. But we start with phase 2, and you'll understand just now why. Okay, we'll go through the different phases. There's 4 different phases. So we start with low interest rates, like we've got right now. Okay, we're at 30-year lows. Inflation, basically under control. We're in that zone, what they call the target zone, between 3 and 6%. However, we're at the top of the scale of that range. But the economy is growing steady to average. And we've seen that, you know, obviously we also got this thing with the banks. They're not lending out as much as they want to. They're worried about things. But they are slow. There are increases slowly in spending, things like that. The economy is growing slowly, slightly above average. And obviously now this is where the pressures come in now with high inflation. So this is all part of phase 2. So the fear of inflation forces the central bank or the Reserve Bank to start increasing interest rates. And that's what we just saw now a week ago. So more expensive money will lead to a decrease in spending. Now, and remember the idea is to put your foot on the accelerator for economic growth, but also to put your foot on the brakes to keep inflation under control. So it's a bit of a balancing act. Okay, so we'll see what happens if we'll have more interest rate increases. So that is phase 2. So this is the stuff I got off Stats South Africa and as well as Reserve Bank. This is until July last year. I can bring my little cursor here quickly. You can see where we are between 3 and 6%. We close near to the top of the cycle. That's on consumer price inflation, and this is producer. This is at the factory gate. So you can see the trend is up. So you can anticipate this will be affected over here. This will be going up. Hence the increase in our repo rate last week. Okay, so we're in that zone between 3 and 6%, but we're moving closer to that zone. So we'll see if this little act last week with raising interest rates by 0.5% will start slowing down inflation. because it has a lagged effect. So in phase 3, okay, interest rates will increase further. Okay, and you'll see just now a graphic of this. But there's a lag between the increasing of interest rates and obviously lower inflation. So the central bank or Reserve Bank governor does this little bit balancing act. They worry that's not working fast enough, so they'll raise interest rates more. But ultimately, the main effect of increased interest rates is the effect on spending. So you start seeing that the economy is starting to slow down, and the economy is the GDP, the gross domestic product, that's amounts of goods and services being produced in the economy, starts slowing down. So here's again a slide from Stats SA. This was into the second quarter. That 0 is average growth, so which is around about 4%. We're trading at about 3% at the moment. Okay. Remember, the main focus is on inflation, not so much economic growth. So as I say, the balancing act. These are things you must be looking for. As an investor, you want to be a bit of a contrarian. There's a saying that says that the night is always darkest just before dawn. So you want to look for signs when it's most intense dark. I don't think we're right there right now. We're not in a recession. We're not coming out of a recession. The economy is doing okay. But things you want to look for to get yourself into the market, when you look at newspaper headlines, look for redundancies and brain drain and shortage of skilled labor, all those headlines being lamented. Okay, that means that just at the worst, we're at the bottom of the economy. The level of unemployment, and yes, we've always had a high level of unemployment, but you want to look for those kind of things. You want to start seeing things picking up. Okay. Also, how market reacts to news. I remember a week or so ago, any good news, the market would fall. So that's how the market would react to the markets. When the economy is expanding like crazy, everything is rosy, you find that things are bullish, the market doesn't even react to any good news. Okay. Level of bad debts, so obviously that does reach a peak when the economy is at its lowest. We also see a decrease in insolvencies and things like that. Those are all telltale signs where we are on the cycle. The shops become empty, there's more vacancies and things like that. Obviously, there's also less customers during the recession. More telltale signs that the recession is near the bottom. The length of the sales. The long sales would indicate overstocked position. Okay, that would be a sign of a recession. Slightly shorter sale, obviously, we're gearing up now. Advertising revenue, this is what I always used for years and years. The thickness of the Sunday Times newspaper. You find the thicker it becomes, obviously there's more advertising in the job side, but also there's more houses for sale, activity and things like that. The thinner it becomes, obviously there's a recession. Another telltale sign, if you look at the number of cranes on the skyline, when those disappear, you know that the recession is almost over. Because the building construction sector is one of the last sectors to move in economic boom. Okay. So, coming back to our 4 phases. In phase 4, inflation is once again under control. The slowing economy begins to worry the Reserve Bank. So obviously they want to stimulate the economy, put the foot on the petrol, so now they start cutting interest rates. So you start seeing the trend of interest rates start coming down, and the objective is to increase consumer spending. So usually this arrives a little bit too late, and obviously economic growth slows down. It even comes down to a standstill. So it's a bit of a balancing act for the Reserve Bank, but sometimes you might slip into recession or recession. Remember, recession is two consecutive quarters of negative growth. But you find that the interest rates are falling at a faster rate, and that's where we start, we're trying to manipulate the market. And that's what we saw now in the States, and we saw now in Europe and things like that with the God's interest rates. In phase 1, we'll come back, you'll see a graph now. In phase 1, the economy is leveling off. We're starting to grow at a faster rate, although it still might be below average. At the end of this phase, the Reserve Bank is happy with economic growth. They congratulate themselves. They think, we've done a good job of playing this balancing act of reading the economy. And then obviously they don't cut interest rates anymore. Okay. And we start with phase 2 again. But here I'll show you in the next slide what I mean, how these things all fit together. So I just want to make a highlight first of all. This is just for guidance. It doesn't exactly happen like this. I just want to show how the 3 variables fit together. So first of all, you got this blue line, economic growth, GDP, economic growth. Remember this here is 4%. That's where we talk about average growth. So we are still below average growth. This is where we anticipate we are. And interest rates, okay, we are 30-year lows and we're starting to move up. Okay. So yes, the economy, the stock market is still way above average. And you'll see in the next slide what I mean by that. But when it comes down below this average, doesn't mean that the economy or the stock market is slowing down or there's negative growth. It just means that the growth is below average. Okay, so you can see this interaction and the different phases where these things fit through. Okay, so I anticipate we're roughly here at the end of phase 1 as interest rates are starting to go up. So that's where I anticipate us to be. In the next slide, you'll see the table format, and put it all together, different phases. In phase 1, you see that the economy is below average, and the Reserve Bank government will be increasing or decreasing interest rates to stimulate the economy, and you'll see the stock market's above average. So always think of the interest rates in the stock market like a seesaw. Interest rates coming down, stock market goes up. Okay, in phase 2, you find economic growth. Obviously, it's above average now, and inflation may be getting out of control. So you start seeing an increase in interest rates, and obviously the stock market starts moving below average. In phase 3, very much the same scenario. In phase 4, now the economy is starting to slow down. It's below average. We start decreasing interest rates again to stimulate the economy. Okay, so the economy grows above average rates in phase 2 and phase 3. Okay, so that's where the economy is. The stock market, on the other hand, is the other way around. Okay, the stock market phases above average rates, okay, is in phase 4 and phase 1. Okay, so you'll see how I've put this all together just now. The stock market discounts future events. Okay, a downturn 9 to 18 months in advance. So obviously there will be a peak in economic activity 9 to 18 months in advance, and that will be reflected in the stock market. And that's what we see right now. We're trading very close to all-time highs, but also on the other side of the coin, the stock market moves 4 to 6 months prior to a trough in the recession. Okay, so you see a very strong economic recovery 4 to 6 months before the economy starts bottoming out. And obviously you see this acceleration through the trough of the business cycle. So now, as an investor, you want to start looking for bargains. So the economy is slowing down, the stock market's been hammered. You want to look for bargains in phase 2. So as a value investor, you pick up the bargains in phase 2. You want to start investing in phase 3. Okay, so I hope that makes sense to you guys. Please go review the tutorial on the website, Macro Fundamentals, on the tutorial number 3, to give you more insight into that. So this is what's happening on our market right now. The blue line is the JSE All Share. As I say, we're trading at all-time highs, very close to it. This is a weekly chart of the JSE All Share. And this other graph, I've only got data going back to 1998. This is the repo rate. So 1998, we had the Asian crisis. If you remember, interest rates went from 15% to 21%. What happened to our stock market? Our stock market crashed. Doesn't really show you here. That was a 45% drop. Interest rates went up very sharply. Our market came down very sharply. But over the last few years, you can see our interest rates have come down and how the stock market's gone up. When interest rates go up, you can see how the market comes off. Okay. Yeah, the economy is doing very well. And then we had the 2008 crisis. Okay. Interest rates went up very sharply, and our market came down very sharply. That again was a 46% drop. Okay, and since then, interest rates or repo rate has dropped right down to 5%. We just had this slight little blip there. You can see that, to 5.5%. So you can see the cycle, how these fit together. When interest rates start going up, what happens to our market? It doesn't have to come down very sharply, but you anticipate our market will be topping out. So obviously, as an investor, you want to position yourself accordingly. Okay, guys, quick summary. Our time has run out. Economic analysis, remember, we want to determine the level of interest rates and obviously anticipate the long-term trend for price earnings ratios and how these things all fit together. So it's important to follow, especially monetary policy and interest rates. What will the Reserve Bank policy be regarding interest rates? So Reserve Bank Governor or Jill Marcus, go Google her speeches, go read up the newspaper articles. What did she say about inflation? What did she say about economic growth? Okay. And I mentioned there's a lot of other things you can use to indicate changes in the economy. These are the simple tools you can use. Okay. So quickly before we end up and tackle any questions, our upcoming webinars. Next week we're talking technical analysis, very basics. What is technical analysis? Some assumptions around that. So that's next week Wednesday. Like of this webinar, I was quite impressed. The first time I've had a full house with fundamental analysis. I found in the past technical analysis is more popular. They fill up very quickly. So please go book up. I only take the first 100 people. Okay. The week after that, very much touching on what we spoke about today, but going into more depth. We talk about inflation, interest rates, and GDP, how these things all fit together. And then the last one for this month, February, we're talking about moving averages, but also we're going to be talking about things like Bollinger Bands. How do you use them? I use them a lot with my trading. Very, very simple tools, but very, very effective. Then our Traders Forum, we got one next week here in Joburg, our first one for the year. We'll be discussing our market overview, as well as trading equity derivatives. It's being held here in Bryanston from 6 o'clock to about 8 o'clock. But please come join us afterwards. We have snacks and drinks, and that's where the opportunity where you can network and with other investors and traders and talk about the market. We did it the first time in December. It was very, very popular. I did it in Cape Town, so I'll be doing it in Durban also. So you guys in Durban, I'm coming down a week later, the 18th of February. Please go onto the website and book. Because seating is limited. So first come, first serve. Okay. So, guys, I hope you've enjoyed this presentation. As I say, it's based on the online tutorial number 3. When you get this presentation, please review it. Also listen to the recording. Any questions you have, you're welcome to email me or phone me. But also support us with our webinars. And I do appreciate you guys being on this webinar. We need to see if there's any questions coming through here quickly. Before we sign off. Wow. Guys, just keep the questions small, short. Okay. Long questions. Okay, Jack, I've spoken already about the interest rates. I mean, the stock market and the Rand hedge stocks. Well, okay, what sectors will be influenced by interest rate hike? EJ, great question. Just think about it. Any interest rate sensitive sectors will be influenced. So first of all your retailers, your credit retailers will be affected, and we saw that. We saw the shares of Foschini and Truers. These guys been hammered. Not so much the Woolworths, obviously different LSE market, but your interest rate sensitive sectors. So yes, it will be the consumer related sectors will be affected by the increase in interest rates. But also on the other hand, your banks, obviously you might have an increase in interest rates. Banks will have more bad debts. Yes, they do make allocation for that, but obviously you might have an increase in bad debts. So the banking sector can also be affected by that. Okay. Not so much the food retailers, but more the clothing, apparel retailers will be affected by rising interest rates. Okay, great. I hope that answers your question, EJ. Thank you. Where can I get stats for demographics? The two best websites I can use, and you can get the links in the presentation, is Stats South Africa, but I found that you can get a lot of information on the Reserve Bank website, resbank.co.za. There are links in the presentation. So that's where you get a lot of information on the demographics and things like that. Okay. Will there be interest rate increases to slow down GDP? Will the interest rate increase? So a question from Dion. Not further slow down GDP. Yes, that could be the problem. As I say, it is a balancing act. On the one hand, you want to put your foot on the accelerator for economic growth, but more important, remember the Reserve Bank has this mandate to keep inflation under control. That's public enemy number one. So yes, it could have that effect on the economy, but remember, it's a weakness of the rand that's affecting the inflation. So if we raise interest rates, obviously we become more competitive compared to other interest rates around the world. You might have more funds coming into South Africa. That's the kind of things you're looking for. So if you want to answer your question, a bit of a balancing act, yes. There's Benita question here. Explain again why market doesn't respond well to good news. Benita, that was about 2-3 weeks ago. It was a bit of a conundrum for us, where the economy was doing well, any good news, the market was going down. Because remember, it was tied up with the whole Federal Reserve maintaining the stimulus. So anything to do with the economy is doing well. Obviously, implications was for the Reserve Bank to start tapering off on economic monetary stimulus. Remember, they started cutting back on $10 billion a month on the $85 billion on the bond repurchases. So that was bad for emerging markets, and that's what we seen in the last 2 weeks. There's whole emerging markets having a bit of a healthy correction. It's a lot to do with that. So 2 weeks ago, we saw the market not responding well to good news in anticipation of the Federal Reserve cutting back on stimulus. So I hope that answers your question, Benita. What does the South African Reserve Bank do when the economy is slowing down, but inflation is increasing, which appears to be happening right now and seems to be the general fear? That is a good question from Gerard, and that's exactly what the Reserve Bank did, was to raise interest rates. That's what they do. That's the mechanism they use. That's the tool they all use. It's not so much the economy they're worried about, it's more inflation. As I say, public enemy number one is inflation. So they use interest rates to slow down spending. Obviously, spending is increasing that demand for goods and services. So yeah, that's the tool they'll be using, interest rates. So Gerard, I hope that answers your question. There's a question from Martin. How long will it take for a phase to complete fully? Various ranks, various desto cycles. So there's no real hard and fast rule. I was reading an article about the business cycle lasting from a few months to a few years. You're talking about the long-term cycle. So it's a combination of all these different cycles. So to answer your question, Gerard, there's no real hard and fast duration. You just need to look, that's what I say, you need to anticipate these changes in the economy, looking at those telltale signs. Okay. Sure. Guys, thanks for these questions. I really appreciate them. For the average person, in what phase is it recommended to start investing? In Lovo, I think I mentioned that it was phase 2, if I remember rightly. Just go back to 2 or 3 slides. When the economy is overheated, the stock market will be at the bottom of the cycle. Whatever else is negative about the stock market, that's the time to be getting in. So yes, in phase 2, looking for the bargains and start investing in phase 3. So Alfred, I hope that answers your questions. Okay. Great. So the slides will be sent to you guys. Great. Guys, thanks a lot for your questions. Yes, Mr. Patel, I'll be sending the presentations to you. Okay. A question here from Ashley. We had a great fall now. Do you see the stock market recovering? Yeah, obviously there will be some bargain hunting, Ashley. The market, I saw in the States, the last 2 sessions, they fell about 3%. From a technical point of view, we don't have a depth cross yet. The 50-day moving average hasn't crossed below the 200-day moving average, so we still have a bullish market. So the market has pulled back in the short term. Yes, might be short-term trading opportunities, but saying that, our market not cheap from a valuation point of view. We're trading on a PE of 18, so I won't rush out and go full on hell for leather to build up a portfolio right now. I'll wait for a bit more of a correction before starting in the market. If I do have existing portfolio, I'll hold my shares. Okay. Guys, thanks a lot for your support. Thanks for your questions you have. A lot of questions coming through. Great. I hope you've enjoyed this. Here's my my email address. There's my phone number. Thanks for your support. Thanks for being on this webinar. I hope you've enjoyed it. Until next time, next week, thanks a lot. All the best. Bye-bye.